Are we heading towards a recession?
We're heading towards a slowdown. Whether that actually leads to a recession is dependent on things we can't forecast at this moment. My own guess is the odds are less than 50-50 that we're heading to a recession. But there is no question we've got significant pressure on home prices, which I expect to move down considerably lower. And that will curtail the net housing wealth of the American household. And history tells us that causes some weakness. It's too soon to call this one way or the other, frankly.
You mentioned housing. There's been a lot of debate about your role with the so-called housing bubble, your whole role in terms of subprime interest rates for housing. This is how Condé Nast, a portfolio, wrote about it, John Cassidy. He said this: in 2004, as the subprime boom was cranking up, Greenspan advised homeowners to switch from fixed-rate mortgages to adjustable-rate loans. To April of 2005, in a speech that probably now haunts him, he said innovation has brought about a multitude of new products such as subprime loans and niche credit programs for immigrants. Such developments are representative of the market responses that have driven the financial services industry throughout the history of our country. Where once more marginal applicants would simply have been denied credit, lenders are now able to quite efficiently judge the risk posed by individual applicants and to price that risk appropriately. Are you responsible for this bursting of the housing bubble?
No. Shall I explain? First of all, I did make a speech in February of 2004 in which I explained a fairly interesting analysis by the Federal Reserve staff, which said that there were a lot of home buyers who would do far better were they to take adjustable rate mortgages because they weren't going to live in the home long enough. And the price they were paying to get the fixed rate mortgage was exceptionally high. Now, this incidentally was not subprime. This was prime adjustable rates. A week later, I show up at the Economic Club of New York, and with 1,000 people asking me all sorts of questions, I shouldn't put 1,000 people there and a couple of people asking me questions. The question that came up right at the top: are you, say, disparaging the 30-year mortgage? Because the issue was that versus adjustable rate. And I said, no, on the contrary. When I take out a mortgage, I take out a 30-year fixed rate mortgage. I was referring to a special small category of people. But it had nothing to do with subprime. But with the whole housing boom, we're dealing with a world problem. More than two dozen nations are experiencing exactly what we are experiencing. In fact, our housing price boom is less than the average. And this is very clear. This very clearly calls for a global explanation, not for an individual explanation of what the central banks do. And indeed, central banks around the world have largely lost their power to affect long-term mortgage rates because it's global forces which are pushing it, and we proved it. We tried to raise the rate in 2004 and we failed. We tried again in 2005 and we failed. And so it's very clear to me that central banks, ourselves, the Federal Reserve included, had very little control over the extent of that boom.